Late November here at the Frankfurt Stock Exchange, right in front of it, weather is getting colder, but financial markets are actually warming up to some positive thoughts about 2024. Expectations for next year have been upwards, so there's a kind of positive sentiment for fixed income as well as equities. So why is that? Because if you look at the geopolitical situation, it's still tense. The major learning has been from the Ukraine war and the hot conflicts, now the latest being in Israel, the war breaking out, is that capitalism on a global basis seems to find ways around the hot conflicts. So oil prices been subdued, commodity trading has been around Russia, have been finding new ways, and the Israel conflict doesn't seem to disturb us at all, despite the fact that initially oil prices had a spike, but it calmed down quite fast. So what's happening in geopolitics? Well, Joe Biden meeting President Xi last week in San Francisco, only a few calm words have been satisfying for markets to calm down again on geopolitical tensions. What are the implications? There's new alliances globally. There's Russia and China. There's the BRICS country extended to more than 7 more countries. There's also the Arab world changing the role of the Arab world with new self-confidence. G7 impact declining, and it all has an impact on global trade. We've seen the latest numbers on global trade disappointing, especially in and out China. The numbers are slower than what we used to be. So what is the implication? Implication is that global trade is changing. We have the repatriation of industries. So the Eurozone, Germany, United States, they're all trying to get back critical industries into the country, build new production facilities, and there's less trade concerns as we used to have during the COVID period. Financial markets, are they concerned? No, financial markets seem to see the opportunities in this new geopolitical order. There seem to be opportunities in investing in the G7 countries, as well as opportunities in investing in the countries around China. So let's have a look at the economic implications. What are the growth expectations into next year, and especially what about inflation? Now, astonishingly enough, over the past 2 months, inflation expectations have come down significantly. Investors don't seem to be concerned at all about inflation next year. Expectations, economists expect below 3%, more like 2% inflation rates next year in the developed world and also in China. And growth, what about growth? What about the recession expectations? We all expected a recession in the US, but stubbornly the US economy is holding up, currently running at a 5% growth rate. So what's going to happen in next year? Dangers are that in the first 2 quarters we get negative growth in the US, but do we care? It looks like investors look through that period, that possible period of weakness in the US, while having a close focus on weekly numbers on unemployment and the US consumer. So unemployment claims, yes, they picked up a bit. So that's a very early sign that the strong labor market is getting weaker, but they are still far below historical averages that we've seen on the pre-COVID times. Same is true for the consumer. The consumer holding up quite well. Consumer sentiment has been on the decline a bit. Mortgage rates are still around 8%, which should, in a classic dependency, actually bring the housing market down. But what happens currently is actually that sales of existing homes are on the decline. There are no fire sales because people have problems with their mortgages. Why is that? That is why the number of mortgage-free housing in the US has increased to a record level of almost 40%. So there's less dependency on mortgage rates for the housing market. There's less availability. That is why prices are holding up for existing homes. An astonishing development in historical comparison given the high interest rates. So looking into next year, it looks like people expect a soft landing. The danger is so that one factor is neglected. That is the time lags of monetary policy, rising interest rates, restrictive monetary policy, the time lag could be up to 24 months or longer before they bite and get the economy down. That would be in next year in 24. So the jury is still out to see how much restrictive monetary policy will bite with a time lag next year in the US. In Germany, today's PMI numbers also on a Eurozone basis actually show we're holding up on a very low level. Durable goods, industrial production, services, it's all been ticking up a little bit. The composite PMI has been picking up, so we still slide along the zero line, and financial markets don't seem to care. China is fighting the real estate crisis. Little glimpses of hope, but experience shows real estate crisis is taking a long time before it's going to be over. So China expectations for next year are still subdued. So what does it mean for asset allocation and financial markets looking forward into next year? The most astonishing factor to me is that over the past 2 months there's been quite an optimistic sentiment building for global fixed income markets. People expect US interest rates to decline further, and people expect quite positive returns on global fixed income investment, especially on government bonds and corporates. That might be an illusion given the fact that even year to date we are still only in a slight positive territory for fixed income markets, and it's not sure that interest rates are going to fall as fast as people expect currently. That has been translating into positive return expectations for equity markets. Also, the earnings season has been within the classic pattern of about 82% positive surprises in the US in the third quarter, little above 50% in the Eurozone, but still in a positive territory. So the optimism in financial markets is not really justified by really great expectations for earnings next year, given the only 0.5% or 1% GDP growth rate. But it seems like companies are actually dealing quite well with the global challenges of trade disturbances, production problems, and consumer weaknesses in certain niches. So yes, how to get decent returns into the next year? It seems like it's a problem with fixed income. Maybe fixed income expectations are overdone. So the only possibility to get decent returns again next year will be if you go into risk. We need to take equity risk, probably take high yield risk, and we need to be selective what we buy, because the experience of 23 has clearly been that there's a lot of differentiation between countries, sectors, successful companies and failing companies, and that will continue into the next year. That is our major challenge.